KPIT Technologies' recent Q4 results, and you find yourself at a collision point of conflicting market signals. It is a classic institutional paradox, a period of slowing growth met with aggressive upward price target revisions. On the surface, the optical metrics look weak. Constant currency revenue growth for the quarter was flat, registering at just 1.8% sequentially. The bottom line showed a similar miss. Profit AFS came in at 1,630 million rupees, well below the institutional estimate of 2,165 million. Simultaneously, the company reported an unusual contraction in its workforce, with net headcount dropping 1.6%. Management compounded concerns by warning of a near-term revenue headwind. Two major legacy software-defined vehicle programs terminate in the first half of fiscal 2027. This friction arrives as global demand for passenger cars remains soft, adding a layer of macro uncertainty to the report. Yet, despite these headwinds, institutional brokerages like Motilal Oswal and Choice Equities are reiterating buy ratings, with price targets ranging from 970 to 1,030 rupees. Management remains equally bullish, projecting that EBITDA margins will reach 22 to 24% by fiscal 2029. This disconnect exists because these analysts view KPIT as a transitioning product architecture company, while the broader market is still valuing it as a traditional linear IT services firm. To understand this pivot, we have to look past the top-line noise and isolate the structural shifts within the Q4 data. This quarterly performance table details the optical weakness. Revenue sat at $185 million, while profit after tax fell to 1,630 million rupees. But notice the resilience in the EBITDA margin. Despite top-line stagnation, margin actually expanded 25 basis points quarter over quarter to reach 15.9%. Profitability remains steady, even as the total engineer headcount declined. This indicates a decoupling of revenue from labor, a break from the standard IT services growth model. In a traditional time and materials model, you scale by hiring. More billable hours require more engineers, a dynamic that naturally constrains your total margin potential. The data suggests that KPIT's Q4 performance isn't a failure of demand, but the mathematical signature of a company deliberately restructuring its revenue model. This restructuring is only possible because KPIT is addressing a specific engineering bottleneck in the automotive industry. This represents the legacy architecture of a modern vehicle. It is a highly decentralized web of independent components. Most vehicles on the road today rely on 100 to 120 discrete computers, or ECUs, to function. Attempting to run over 300 independent software features across this fragmented hardware creates massive communication complexity. The industry is moving toward a centralized, software-defined architecture, where all systems flow through a unified stack from the chip to the cloud. In this new environment, the bottleneck isn't writing the code for a specific feature. It is the end-to-end integration of those features into a single, cohesive architecture. While many engineering vendors specialize in specific narrow domains, the complexity of a software-defined vehicle requires a broader view that many firms are not structured to provide. KPIT's competitive advantage is its end-to-end coverage. They manage the entire software V model, from architecture and middleware to validation and cloud services. To secure this moat, KPIT used strategic acquisitions like Automotive for cybersecurity and Helm.ai for autonomy, ensuring they own the critical components of the software stack. By positioning themselves as the primary integrator for this hardware-to-software transition, KPIT has built a level of pricing power that traditional service firms rarely achieve. KPIT is now translating this engineering moat into a new financial structure. The company is aggressively moving away from legacy time and materials contracts, where revenue is tied to hours worked. Over 80% of their new contract wins are now structured as fixed-price or outcome-based engagements. By utilizing their Beacon platform, which uses AI and reusable assets to accelerate delivery, they can fulfill these fixed-price contracts more efficiently, capturing the cost savings as profit. This revenue split shows the scale of the transition management has planned for the next 3 years. In fiscal 2026, the business was still heavily reliant on services, which accounted for 85% of the mix. By fiscal 2029, the goal is to have 60% of revenue coming from high-margin solutions and products. This solutions segment is currently growing at a rate of over 30% year over year. The $349 million in new deals won during Q4 is a direct reflection of this high-margin product pipeline. This transition toward productized software alters the company's unit economics, creating a path for margin expansion that is no longer strictly dependent on increasing the size of the workforce. Even with this new model, we have to address why management expects growth to remain flat through the first half of fiscal 2027. This dip is a temporary side effect of the transition, as the company sheds legacy passenger car programs that no longer fit their high-margin focus. Beneath that headline weakness, however, other high-growth segments are beginning to drive the portfolio. Look at the regional divergence in this table. While traditional markets slowed, Asia saw a massive 25.1% quarterly surge in revenue. That growth in Asia effectively countered a 7.1% decline in European revenue during the same period. This regional growth is paired with sector-wide strength in commercial vehicles and off-highway machines, which grew 11.6% quarter-over-quarter. A landmark $50 million deal for a software-defined machine platform is now anchoring this off-highway business. Strategic cockpit wins with Japanese Tier 1 suppliers are also providing a critical lift to the Asian market. By aggressively diversifying into high-growth industrial and regional niches, KPIT is insulating itself from the stagnation of legacy passenger car markets. When we synthesize these variables, the question is whether KPIT can actually reach its 24% margin target by fiscal 2029. This graph maps the trajectory management must maintain to hit that long-term goal. We start from the current baseline of 20.6%, factoring in a minor dip in early fiscal 2027 as autonomous and EV programs face temporary delays. A recovery follows in the second half as delayed programs move into launch phases and integration demand picks up. The final climb into the 22 to 24% zone occurs as the shift toward a 60% solutions mix fully matures. The short-term volatility seen in the Q4 report is the necessary cost of reallocating resources toward this more profitable, product-led architecture. KPIT's comprehensive software stack provides the pricing power required to sustain this margin trajectory. A successful transition to this product-led model aligns KPIT's financial profile with that of a scalable technology company. This shift provides the structural basis for the higher valuation multiples currently projected by institutional analysts.